Hey everybody, Chuck Barone here. It is Tuesday, August the 15th, 2023. Man, we're ripping through these months quick, man. It's already halfway through August. Wow, time going by quick. Crazy day today. Lots of interesting stuff to talk about with you guys, like always. But before I get rolling, let me welcome everybody to the show. Thank you guys again, as always, every day for your support. You guys showing up and watching these videos, sticking with us, means the world to us, guys. Appreciate it. All right, so let's look at these markets today. Well, the big news today coming up, retail sales. Big number, jumping almost double what analysts had expected. Putting a little bit of fear into the market. Yesterday was big optimistic day. The Fed's done cutting rates. Today's fear day. Maybe not. The economy is a little hot here. And as a result, the market just squealing all the way to the end. The Dow dropping 361 points, 34,946 on the Dow. The S&P, the broader market, down 51 points. That's a pretty big move. 4437 on the S&P. The NASDAQ down 157 points, 13,631 on the NASDAQ. Market's not liking the conditions, the uncertainty now of the Fed. They kind of felt like they had it dialed in. I don't know. I think, you guys have known, you've heard me say since we're not going to get out of this. I still think we're going to get at least one more hike this year, likely two. These markets backing up, my opinion, at least right now. Now, there's going to be a lot of data coming between now and September 20. So we'll see how it goes between now and then. But at this point, if I was placing a bet, my bet would be on a rate hike coming in September. Bond market today, not much happening today. Kind of a quiet day. The 10-year up 4 basis points. The price is coming down. The 10-year, the rate's going up 4.22% on the 10-year. The 2-year actually coming down today after a big jump yesterday. Down just 1 basis point, 4.95% on the 2-year. So the inversion continuing to narrow. Now we're down to 73 basis points. Let's see how close we're going to get back to a normal yield curve. The yield curve right now still predicting recession. I guess it's going to stay inverted till it gets that recession. I don't know. Because the economy, at least the data we're getting, is showing the economy may have some soft spots in some places, but certainly holding up with, retail sales, spending on consumer spending, with employment, businesses hiring. So we'll see where it goes, man. We're going to watch this stuff for you guys. The dollar today up very small, just fractionally. 103.21 on the index, is still a very strong dollar. And of course, a strong dollar leads to declines in gold and silver. Gold declining $4.60 today, $1,902.20. So down about $100 from its peak. Silver down 7 cents today, $22.52. That's down about 10% from its peak. So this metal's correcting with this stronger dollar. We'll see how long this dollar can stay at these lofty numbers. Right now, the king of the hill, keeping pressure on gold and silver prices. Oil, our friend oil, coming back down to earth here, down another $1.52 today. $80.99 for a barrel of West Texas Intermediate. Was up around $85, coming back down. We'll see. We were kind of getting ready to kind of revise where we believe oil is going to be trading. But as it continues to come back down, we'll see if it comes down back to the trough it seems to be most comfortable in, $70 to $75 per barrel. Of course, we're going to watch that every day for you guys as well. Bitcoin today down small, down $177, 29,176 for Bitcoin. I was reading, there's a lot of activity happening in cryptos right now. Apparently, the Federal Reserve not a big fan of some of these ideas. We'll see. We're going to do the research. I just saw a big article on that. So we'll be talking a little bit about cryptos tomorrow's show. All right, so let's talk about news today. Well, the big news of the day, retail sales. Consumers continuing to spend spending those extra wages they're earning and continuing, obviously, to spend money they don't have, with credit card debt now topping $1 trillion. But retail sales jumping 0.7% just last month. Well, that's a pretty, retail sales have been pretty strong. So a number like that, wow, big news on the economy. Experts had just expected 0.4% increase, which is a pretty big jump. This number actually almost doubling what they were predicting. Surprisingly, traders in these markets still betting no rate hike in September. Well, I'm telling you guys, if the numbers continue to come in like this, employment strong, retail sales strong, the economy seeming to continue to go strong, inflation numbers moving now in the wrong direction, going up instead of coming down, even if it was just 0.2 of a point. 3% is better than 3.2%. It's lower. But 2.8 would have been better than 3.2. Didn't happen, right? So traders insisting, and I think this is, I don't know if it's wishful thinking, if it's the market just, wants rates to not go up any higher, so they're going to stamp their feet and bet that way till they're proven wrong. But I'm telling you guys, if the numbers continue to come in this way, I would be amazed if we didn't get another bump in September. Not only that, you got the Fed yo-yo parade going, right? You got Neil Cash and Carey, my buddy. You got Daly and a whole bunch of others coming out saying, rates may need to go higher, rates may need to stay stronger. They've always come out and foreshadowed the next hike. So we're going to keep an eye on that as well. Now, you do have some doves in there, some doves on interest rates, wanting to, let's pause and see the full effect of the rate hikes we've already implemented. Well, the jury is in, man. This economy refuses, at least at this point, to go into recession. And I got a feeling, guys, that when next year rolls around, in an election year, the Fed is going to be loath to really be intervening in the markets, to be intervening in this economy during a presidential election. So it's going to be fascinating to see exactly how this continues to play out. I really think that I'm going to watch closely to see if the usual group is going to come out talking about more rate hikes. That seems to be the consensus right now, the hawks outnumbering the doves. Obviously, all of this stuff is very, very data sensitive, subject to change. But if I was a betting man and things in the lay of the land around September 20th is the same as it is right now, I would think another quarter-point hike would be, I think it's already pretty much a done deal. The Fed telegraphed a long time ago that their target number was 5.6%. Another quarter-point rate hike gets us to 5.6% exactly. So I'm of the opinion the Fed they haven't been hiding anything from us. They've said it exactly what they're going to do. They've foreshadowed it all. Sometimes the market doesn't want to believe them, right? But they've been saying it, they've been doing it. I really believe we need to listen to them until they prove us, give us obviously there's a lot of reasons to not, but they're the voice. They're the ones who are going to make these decisions. If they're warning they're going to, you might want to take that warning seriously. More big news today. Fitch in the markets again. As you know, they downgraded U.S. banks, several of them, regionals especially. They downgraded the U.S., yay, Fitch, downgraded U.S. credit rating, now coming in saying they might need to downgrade the U.S. banking sector, U.S. banks, big banks, including J.P. Morgan, as it continues to assess, this is great here, guys, the operating environment of the industry. They downgraded the operating environment one more time. If they downgrade the industry again by just one more notch, it would force Fitch to do a reevaluation of more than 70 U.S. banks with a likely credit downgrade for all 70 banks. And banks, they're wonderful at passing costs along, so if it costs them more to borrow money, they're going to charge you more. So this is a stealthy way of slowing the economy down here. I think, we'll see. The banking environment is a tough one right now, especially the regional banks with this commercial real estate collapse coming. It's kind of been a slow down the hill so far, but like we've talked about before, once that snowball gets rolling and starts to get bigger and bigger, it rolls down the hill faster. And as in response to that, I saw this today, man. This is a great Wall Street companies, Wall Street investment firms, including Goldman and a shit ton of big real estate groups, licking their chops, ready to jump in and scoop up commercial real estate on the cheap. A lot of commercial real estate absolutely being pulverized right now on what the values are. Mall properties down 70%. So these companies, the Wall Street vultures, licking their chops, figuring that they got some easy money coming to them. They're raising billions and billions and billions of dollars for this purpose. And you know how the way these deals kind of go. If commercial real estate really has a catastrophic collapse, and it puts big pressure on all of those lenders who have commercial real estate loans outstanding, more than $1 trillion worth coming due, well, I think what's going to end up happening is what always happens. The government will do their bailout. The bigs will come in, the Wall Street schmucks. They will cherry pick the very best of what's left, take it, buy it on the cheap, and leave the rest, the dreck, the crap, the bottom, all the non-performing to us, the taxpayers. And the government goes along with this kind of crap endlessly. It drives me friggin' crazy. I mean, really, the government doesn't have, with all the billions and trillions of dollars they spend, they can't find one real negotiator? Why? Oh, maybe it's donations. Maybe it's the political machine that constantly needs to be raising money. And the only way they're going to get it is by catering to the people who have the money they need. And they do that by torquing everything to favor these people. Such is the state of things here in the U.S. today. Anyway, guys, an interesting note too. One last thing. Consumers, I guess, feeling as optimistic about things as Wall Street is. They believe that inflation will be sitting roughly 3 to 3.5% this time next year. So they're not figuring that the Fed will get their job done, bringing inflation back down to 2%. They figure inflation is going to be pretty much right where it is now, a year from now. Well, if that's the truth, guys, what do you think? You think the Fed's really going to be cutting rates? What makes anybody think that? So it's fascinating to see that they believe we'll still have inflation elevated at the same time the Fed's cutting rates. I just don't see that happening, guys. If inflation is 3.5% a year from now, guess what? The Fed funds rate will pretty much be where it's going to be. If they raise again in September to 5.6, and they don't raise again, I'm guessing a year from now, we're still going to have 5.6 overnight. This inflation reading, this one where the consumers are so optimistic about inflation, actually the lowest they've said since April 2021. So in more than 2 years, they believe inflation is going to continue to be elevated. Well, now they think it's going to still be elevated, but happy elevated, and rates can come down because inflation's only 3 to 3.5%. What a load, man. Anyway, guys, that's it for the day. We'll be back tomorrow to bring you guys the news you need. As always, if you like what you're hearing, please hit the like button. It helps our algorithms. It helps get our video out in front of more people. I promise we're going to be way more consistent getting our videos out and getting in front of you guys every day. I know we've been a little slack on that, but we appreciate your support. We're going to do the best we can to bring you guys the news you need, important stuff every day that can affect your wealth, your portfolio. We'll be back tomorrow. Until then, guys, take care. Thanks.